Okay, today we have chapters 3 and 4. We start off with chapter 3, the end of the accounting cycle. So last class, we did the beginning of the period. Today we do the end of the period. Last class made bookkeepers out of you. At the end of this class, we can call you accountants. Kind of. This class is really the difference between bookkeeping and accounting. So what do we do at the end of the period? We had our financial statements. Well, let's back up. We wouldn't do the financial statements without going through chapter 3. So we take our trial balance. Our trial balance has a bunch of stuff on it. Now we have to make sure it's accurate. We have something known as the cash basis of accounting and something known as the accrual basis of accounting. In the cash basis of accounting, transactions are only recorded when they affect cash. In the accrual basis of accounting, transactions are recorded when items are earned, expenses are incurred, liabilities happen, assets are owned, whether or not cash exchanges hands. And we have something called the modified cash basis, which is pretty much what we did. Last class, we recorded accounts receivable, we recorded accounts payable. It's not the cash basis because we're recording revenue when we've earned it, not when we got paid. And we're recording expenses not when we paid for them, but when we incurred them. But it's not perfectly accrual yet. This class, we get to the perfect accrual system. And one of the first things we're going to talk about are expenses and revenues. So let's take an expense. How many people have a job? Get paid. How often do you get paid?
Weekly.
Every week. And you get paid for the week that you just worked?
Yes. It's depending on the season, but usually it's salary or salary plus salary.
Okay, so we don't want to talk to you. How about somebody that gets paid like every other week with a lag?
I get paid monthly.
Monthly.
Fortunately.
For the month? You get last day of the month for that month?
Yeah, I get the 1st through the 31st.
For that month.
For that month.
That's not a good example. The private foundation where I work gets paid twice a month. Everybody is salary. So the day you get paid pays you for the period that includes that day up to that period. So there's no unowed salary. Anybody get paid like every 2 weeks for the period ending last week? I want to talk to you.
Okay.
That's what we need.
So I get paid every 2 weeks, and the period ending 12/04, which was last Friday.
Okay, so let's draw a little calendar. Monday, Tuesday, Wednesday, Thursday, Friday. 1, 2, 3, 4. All right, so let's assume everybody in your organization only works weekdays. And the 4th was a payday.
Well, actually, the payday is Friday, this coming Friday, but the pay period ended on the 4th.
Okay, so the period ends here.
Right.
So 7th, 8th, 9th, 10th, 11th.
Mm-hmm.
That's the payday. That pays for the 2 weeks ended here.
Mm-hmm.
Okay, so here's the question. And let's say there's only one person in this company and they make $100 a day. At December 31st, how much money will that company owe the employee for time worked but unpaid?
For the month or for the year?
It's only going to be one number, no matter how you count it. Anybody have any?
And they're going to owe them 5 days, right?
Right? I don't know.
I think so.
5 days. So you're going to say 500.
I think they owe. Yeah.
Okay, we'll put that down. since we're taping this and putting it on YouTube, I won't put your name next to that. Yes. Any others? Anybody else want to get in on this? Oh, yeah, it's your company.
1,000.
1,000. Okay.
Because no weekend, just Monday to Friday.
Right. Well, let's figure it out. So let's put the rest of the week, the rest of the month. So if the 11th is a payday, the 25th is a payday. And the 25th is paying for these 2 weeks. Right? That payday pays for the 2 weeks. So when will the 21st to the 31st be paid?
January.
January 1st. So at the end of the year, December 31st, nine days will have been worked, but not paid for. So $900 is the answer. So what we need to do debit salary expense and credit salary payable on December 31st to record the salaries that have been worked but not paid for. And the easiest way I found to do this for any problem is to make a calendar, circle or box the payday, then cross out what it's paying for. And at the end, when December 31st comes, it's fairly easy to see those days that have been worked but unpaid for and have to be accrued. Generally, whenever we have salary expense accrued, we also have to accrue something for payroll taxes. Everybody who gets paid, well, not everybody, I guess there are some that don't, but a lot of people who get paid, your check is way less than what you thought you earned. And that's because of things like FICA, tax withholdings, some voluntary contributions, maybe you share in health insurance. The pieces of it that the employer pays, like the FICA contribution comprising Social Security and Medicare, is what's accrued. The withholdings aren't accrued because that's not coming out of the employer's bank account. So generally, we'll just make an entry for either 7.65%, which is the FICA rate, or 10%, which will also include some workers' comp, unemployment insurance, and things like that. So we would also make an entry for payroll tax expense. Payroll tax payable, assuming it's 10%. So any questions on accruing salaries? Here's one to try, see if you got it. Payroll's every 2 weeks, and payroll's on a Thursday. When you get paid on a Thursday, you're paid for the 2 weeks that ended the Thursday before. It's $1,000 a day, 5 employees. That's $1,000 total for the 5 employees. The only work week day is the last pay date in December is 12/28. How much salary do we have to accrue?
What year? Well, it slides that Thursday along the schedule, so you know if there's, the 28th is on a Monday, the 28th is on a Thursday, so it still adds the day.
No, tells you. The last pay date is 12/28. Pay date's a Thursday.
Of course, it's June.
That's what I said. What else
Yeah.
could it mean?
I obviously thinking very illogically. I think. But
I
thanks,
would,
man.
yeah, I would
Today's Thursday?
I concur. Anybody have some answers? Wake up, Brett.
Salary expense 4,000. Salaries payable 4,000.
4,000.
Yes.
Okay. Anybody else?
I have expense of 2,000.
2,000.
So that's payable.
4,000, 2,000. Anybody else want to venture a guess? All right, let's give it a try. So we know the 28th, whoops, is a Thursday. 7, 26, 25, 21, 2, 29, 30, 31. 30, 31 is Saturday and Sunday, so we could leave that out. Here's a pay date. Here's a pay date. The 14th pays for those 2 weeks. The 28th pays for that. So what we have left is $6,000. 28th is paying for the 2 weeks that ended the Thursday before, which is this date and back. So at the end of the year, we have the 22nd, 25th, 26th, 27th, 28th, and 29th to accrue.
So are the employees getting the cash and you're making these entries to adjust the books? I'm just sort of trying to figure out like my understanding. So like you have an employee that's like owed the whatever, it's like they, even though they worked.
They don't know anything about this.
Got it. So this is,
Yeah, this is just for the books.
intern.
It doesn't affect
Got
the
it.
employees.
Got
If we give them the money,
got it.
then we don't have to do this.
This
because
is
they
on the
haven't been
inside.
paid.
This is not the employee side.
Right. And it's easy to see, right? December 31st rolls around, your employer doesn't say, here's some extra money for the
Right.
days you've worked, we haven't paid you.
Right.
They say next payroll, you get paid for those things. So when we draw the calendar out, it's easy to see the days that we have to accrue. Any questions about this?
It's written here, it's 5 employees, right?
Right.
So you just count 1 employee and,
Well, I said it was 1,000 for all of them.
all right.
So it made it confusing for really no purpose. So it's 200 a day per person. If it was 1,000 each and there are 5, we would just times everything by
Yeah, I
5.
thought that confusing when you said 5 employees. I thought per employee gets 1,000 per day.
Yeah, so if that's what you thought, then just multiply everything by 5. So instead of 6,000, the answer would be 30,000.
Yeah.
It's the mechanics of getting it.
Yeah,
But sorry for being confused. You're right.
my bad.
Okay, so any questions about this?
You just want to have which days you're paying for which again, please?
You're getting paid on a Thursday for 2 weeks that ended the Thursday before. So here the period ends the 21st, the 2 weeks, you get paid on the 28th. That means when the year ends, you haven't been paid for the 22nd or any day past that.
So for 5 days equals 6,000.
6 days equals 6,000.
Why is it 6 days if they got paid on the 21st?
Because you're owed for Friday the 22nd
Right?
and this whole week.
Oh, I see. You're actually including that Friday?
Right. And I don't include the 30th and 31st because that's Saturday and Sunday.
Okay, gotcha.
Yeah, I was almost there. You were saying something and then, I don't know, I say about learning channel. Did it overtime?
The pay date is the 28th, which paid for the 2 weeks ended the 21st. So any work day after the 21st has not been paid for at the end of the year, which is 1, 2, 3, 4, 5, 6.
So the 28th, you're paying for 6 days?
No, the 28th we're paying for 10 days. On the 28th, we pay for the 2 weeks ended the 21st, which would be
Oh, sorry, the next pay period. Please continue, go ahead.
the next pay period we'll pay these 6 days plus 4 days in January.
I don't want to hold the rest of the class. I'm a little lost in what's going to happen out there.
No, can you show us which 2 weeks exactly is the 28th paying for?
Okay. '28th is there, right? And it's paying for 2 weeks that end the Thursday before. So it'll be the 21st, the 20th, the 19th, the 18th, the 15th, 14th, 13th, 12th, 11th, 8th. When you only work weekdays, a 2-week period is 5 days, 10 days for the 2-week period.
Thursday, Friday.
You don't, it's just true, it's more complicated to envision.
Friday, but I was confused for a second. But I get
Yeah, the truth is, making it a Thursday seems a lot more complicated than just the Fridays, which seems like a natural end to the week. But you don't want to look for a job where you only get paid on Thursday, only get paid on Friday, because you can't do anything else for the accrual. I mean, the concept's the same. So it is more complicated to envision, but the process is exactly the same. If you draw out the days, and you know it's a 10-day bi-weekly period, starting with the 21st and working back, you see where it ends.
How did you know that was it Thursday the 28th? Like, did you write Thursday the 28th?
I made it up. It's random, yeah.
Got it, okay.
It's not based on, I figured sooner or later, Thursday 28th is going to happen in December. Doesn't really matter where.
Got it.
But we'll make sure on the test that we have on a Friday.
Okay.
Now, this isn't really part of this chapter, but it goes along with it. And it's an important concept in making accounting a little more easy. And it's called reversing entries. Has anybody ever used or heard of reversing entries? How do they work?
You can delete a journal entry with flips.
You can.
Reverse. Are you saying like flipping a journal entry, like deleting and actually?
No. Deleting is very, very different.
And are you saying like reversing journal entries, meaning flipping it and getting what the opposite of what you intended to happen?
Yes.
I mean, I've seen them before.
They're a correction mark, basically.
Yeah, it's
Not really correction mark. Well, let's talk about this. Let's talk about what a reversing entry is, and let's keep using this payroll entry we've been talking about. Forget about the calendar now. But let's say,
I think last class you talked about it. Is it the same thing that we talked about in last class, like 68, and then they mixed it, they said 86?
that's a transposition error. This isn't an error. This is a technique that's perfectly legit and will be used an awful lot. So let's say payroll is $1,000 for the 2-week period. So what entry do we make every time we do payroll? And we'll just do the entry to record the expense, not all the withholdings and everything else. Every time we have a payroll, we're going to debit payroll expense. I'll call it salary expense. And credit cash. And we go ahead and we're doing that every other week throughout the year. We get to December 31st, and let's say the accrual is $600. So on December 31st, We debit salary expense 600, we credit salaries payable 600. It's just what we talked about now.
When you say accrual, would that be like the portion of the previous example, like the $6,000 accrued to the next accounting period?
Yeah.
Got it.
In the nature of the chapter, it's
Right.
called an adjusting entry, but it's an accrual to record something that hasn't been recorded in the
Got it.
books.
So that
belongs there.
$6,000 is what you're saying was the
The accrual. Yeah. Or synonymous with adjusting entry. Yeah. So at the end of the year, 12/31, we do our calendar thing, and we see that we owe $600. So we debit salary expense, credit salaries payable. What should be the entry in January for the first payroll in January? Well, if we wanted to do it technically, the first payroll in January should be debit salary payable, what we owe from December, debit the portion of what we're paying for the time worked in January, and then credit cash for the same $1,000. Since payroll always is 1,000, doesn't really matter to the 1,000 whether part of the days cross year end. So what do you need to be able to do this? You have to remember you accrued salaries in December that are a part of this payroll. So you have to debit the payable, and then whatever the difference is the expense. A lot of people don't like to do that. They like to make the same entry every single time. So instead of doing this, 12/31, we make this entry. The reversing entry, and a lot of software has a little box you can check. When you make this entry, you can check and say reversing entry. So January 1st, it posts an entry that's the exact opposite of what you did on December 31st. The 31st, we debited expense, credited payable. On the 1st, we debit payable, credit expense. What happens to the payable after we make this entry?
I mean, it zeroes the payable out, but do you want to zero the payable out?
You do want to zero the
want to.
payable.
So it's a matter of just like doing it in one journal entry versus doing the reversing entry and then the second entry.
Well, I'll show you why this is handy.
Okay.
So now the payable's gone.
Right.
Because the payable doesn't reset to 0 January 1st, it carries over. So this debit offsets the credit we recorded, so the payable's 0. Let's make the T account the salary expense. Based on this entry, in January, after the first payroll, what should salary expense in January be? Should be 400. We're going to post this entry, this reversing entry, which gives a credit to the expense of 600. Then we're going to make the same exact entry we make every single time. Debit salary expense 1,000, credit cash. And it'll give you the correct balance that January salary expense should be, without having to remember to apportion the payroll between payable and expense. The reversing entry works for anything like that. And it's fairly handy to know. Any questions about the reversing entry? Okay.
Wait. So you would basically have the negative expense for however long, a few days.
From the first until the first payroll.
Got it.
Yes.
Okay, so you would have that.
Correct. Yep. Okay, what are some other things we have to accrue? We have to accrue interest expense on any loans that are outstanding. So let's say we take out a $10,000 loan on 10/1/14. It's 18 months, 12% interest. Interest is paid along with the principal when the loan matures. What's the entry we have to make on 12/31/14?
We, the company.
We're always, when I say we, we're always the company.
We, the company. Yeah.
We're always the company.
What,
Now, the concept is that when you've borrowed money and there's going to be interest, you have to record interest during the period in which you've had use of the funds, even if it hasn't been paid for. So here we have a loan we've gotten $10,000 on October 1st. So we need to record interest even if we haven't paid it or been billed for it. So the question is, and the entry is debit interest expense, credit interest payable.
3,600.
3,600, 1,200,
200, 300.
300. Okay?
Oh wow. Yes.
Quite a variety.
Yeah, it's $300 in amounts.
So you're changing the 300? Maybe we just let Chillian go first. And then you
Then
can
I
agree.
follow right under.
The only thing that matters is the amount of interest for the period the loan is outstanding. Since the loan is outstanding since 10/1 during this year, how many months of interest do we want to accrue? 3, right? The month of October, November, December, 3 months. Interest is always specified as an annual rate. So it's 3/12 times 12% times 10,000. I did 12% because I could do it on my head, right? 12% is 1% a month. 1% of 10,000 is 100. And we're recording 3 months, so 300. Don't get confused by the term or anything like that. Only be concerned with how many months of interest you need to record.
The 3/12 is to record just the fourth quarter.
It's to prorate the annual rate for the amount of time. 2015, how much interest will we record?
$1,200?
Correct. And lastly, on what date does the loan mature, and what's the journal entry to record the payment of the loan and interest? So what date does the loan mature? 331.
16.
331.16. And what's the entry on 331.16 to record payment of the loan and all the interest?
I mean, can you do it in two separate journal entries?
Yeah, you can.
And the first one would be for the interest, so $300 interest expense, 300 interest payable.
Okay, interest expense. Interest payable.
Loan balance, 10,000.
Okay, so debit loan payable 10,000.
Cash, 10,000.
Okay, cash 10,000. Can't be done.
No, it can't be done now.
I mean, it can be done, but you're not
I
finished.
think
That's
I'm
what
not
I meant.
finished yet, yeah.
You haven't paid the interest.
Well, now my question is that $300, are you're paying the interest for that portion? Do you need to zero out the interest payable?
You do,
You do.
because
Okay.
the bank wants their
Yeah, of
interest.
course the bank wants it.
They don't want to hear that, oh, I've recorded the payable, so
Right.
don't worry.
Don't worry. Okay, and then the third journal entry would be to zero out the. Got it. So it would be 300 plus.
Right.
1,200 plus 600, 1,800 interest. Yeah.
Now, you would only do it like this, or a combination like this, if you're writing two separate checks. The next chapter we're going to do today is on cash. And if we're writing one check for the combined proceeds, we don't want to do it like this. Because in our records, we're going to be looking, when the bank statement comes, for a check for 10,000 and a check for 1,800, and we're not going to find it. Instead, we're going to see a check that the bank paid for 11,800. We're going to say, where'd this come from? It's going to take a lot of unnecessary time.
So it makes it a little bit more tedious to do the entries like that.
Yeah, unless you're actually going to pay it like
Right.
that, then it makes sense. Generally, what we would do would be interest expense, 300, interest payable, 1,500, loan payable, 10,000, cash, 11,800. This way is not wrong. That one generally will be the preferred way.
Third line, loan payment.
Loan payable, 10,000.
Where do you get the 600 to get the 1,800 in cash?
It's the first year is 3 months worth of, so it's 300. Then for all of 2015, it's 1,200. And then for the first 3 months of 2016, it's another 300. So it's really 18 months at 100 a month, or 1,800.
Thank you.
Any questions about interest?
You know, that, 3 over 12 times 12, that's all because we're counting those first 3 months of interest as opposed to only the months of December's interest, correct?
It's the period of time. So if we're doing a whole year,
Yeah.
and you wanted to keep the same formula, it's 12 over 12.
Yes.
If it's half a year, it's 6 over 12.
Correct.
So it's the portion of the year times the interest rate
Yes.
times the face amount.
Yes, I would say that we normally do it for just that month, which case would be one over 12. But that question was worded in a way to say for the 3 months prior, even though we normally do it for 1 month.
Well, the whole concept of this chapter is we're making these adjusting entries only at year end. We're going through and seeing the things that need to be adjusted so that our financial statements are accurate. So it presumes that we're not making monthly interest accruals. If we are, then our normal system will accrue it, and we don't really need to do this. So it would be 1 month in the way you illustrated it. Three separate loan amounts, 3 separate scenarios. Let's see if you can figure out how much interest we need to accrue at year end. What do we get for the first one? Well, what's 6% times 100,000?
600.
6,000. So 6,000 a year is how much per month? 500, right?
Yeah.
And how many months do we need to record?
8.
8 months, right? I always figure it out with my fingers, right? So we need to record the month of May, June, July, August, September, October, November, December. 8 months. So 8 times 500 is how much? 4,000. So calculators are good, but also try to do it in your head and then do the calculator. Sometimes you're going to catch something in your head. I used to have this great student. I loved her. She was fabulous. She worked 2 years for me as a student assistant. But she always made these mistakes because whatever she typed in her calculator, she would read the answer without even thinking about it. So if I gave a problem like this, and I say, well, who knows how much interest? You raise her hand, and she'd have like 5,300,275.01. And she wouldn't even think about the answer as being wholly ridiculous. So I always like to do it in my head as well as check it with the calculator, just to see is it reasonable. Okay, the second one, 8% of 20,000 is how much? 8 times 16, 8 times 2 is 16, so it's 1,600. What portion of the year do we need to accrue? 6 months, half a year, so what's half of 1,600? And the last one, 10% on 50,000 is how much?
5,000.
5,000. So if it's outstanding the whole year, it's 5,000. What portion of the year do we need?
10,
10, 11 months.
11 months.
11 twelfths times 5,000 is how much?
4583.
4,583. So any questions about the interest? You're way ahead of most of the classes. Most of the classes start out by trying to get the full interest over the whole life of the loan. We don't really care about that. We only care about the portion that's related to this year. If we got the loan this year, then it's usually going to be shorter than a full year. If it's outstanding for the full year, then it's a full year of interest. Unearned revenue. Either we have to record unearned revenue or we may have to adjust unearned revenue. Generally, we will have recorded it because the receipt of cash gives rise to having to make an entry. And there's two types, general buckets of unearned revenue. Single shot type items, like we've gotten paid for a tax return we haven't done yet. So we record unearned revenue, debit cash, credit unearned revenue. So when we see unearned revenue on the trial balance, we ask ourselves, have we done what we needed to do to record that as revenue? If we have, we debit unearned revenue, we credit revenue. The opposite of that is where we have multiple deliverables. Two examples are magazine subscriptions and season tickets. The single shot is pretty easy. We either did the work or we didn't. If we haven't, it stays as unearned revenue. If we had, we move it out of unearned revenue to revenue. The multiple deliverables sometimes require calculations. So February 1st, 1,000 people pay $12 each for an annual subscription to a magazine. The first issue is mailed 4/1/15. What's the entry on 2/1/15?
Subscriptions receivable.
Nope.
I wouldn't. $1. I mean.
Nope.
Is that what you're asking?
What journal entry do we make? But what happened on February 1st?
Oh, cash.
There you go. For how much?
1,000.
Is it 12 cents or $12?
That's $1 sign. Cent sign would come after.
What is it? 1,000?
The number of people that bought a subscription.
Got it.
So I'll give you a hint.
It's cash.
Oh,
1,000 times 12.
Cash 12,000.
Yeah.
And subscription payable 12,000.
No.
No.
Payable is what we're going to pay. Debit, cash, credit, unearned revenue. Now, we could make an entry every time we send an issue out. If we do monthly statements, that's how we're going to want to do it. So when's the next time we're going to make a journal entry?
Quarterly? Maybe quarterly journal entry?
Well, we could do it monthly, we could do it daily, we could do it at the end of the year. We do have choice. Let's say we want to do it monthly. So for this transaction, the next time we need to make an entry would be when? Well, why 3/1?
A month later.
Okay, so what entry do we make on 3/1?
I mean, there's nothing to
There's no
report.
activity yet.
Right.
But you should still, I mean, you can't just like skip a month for no reason just because.
Well, as it pertains to this transaction, we can. We'll be doing other stuff. We don't want to go through every other possible, and we just want to talk about this one. So this one, we don't really need anything in March, right?
Yeah.
How about April?
Is it debit, unearned revenue, credit, revenue 1,000?
And we would do that every month. Suppose we didn't care about monthly entries, we just wanted to get the books right at 12/31. So we make that entry on 2/1, because we can't avoid it. We got cash, we deposited, we have to record it. What would be the entry on 12/31?
This would be not making the 4/1 entry.
Correct.
So we have the 4.
We've only made this entry. Now we come to 12/31. We want to make sure the books are accurate.
11,000 to
It would be 11,000. You're not using your fingers. I gave you the secret to success in accounting.
April, May, June, July, August, September, October, December. It's 9, right?
9?
Yeah.
Is it?
I have to check it.
Hold on.
April?
April, May, June, July, August, September, October, November, December. Yeah.
Yep.
Yeah.
And no matter what type of multiple deliverable it is, the concept's the same. People have paid for a certain number of things. However many you delivered is that percentage you can record the revenue on and move it out of unearned. So if they're season tickets, however, you could do it, you could break this down to a per subscription or a per game basis, then times it by the number of games. You could do it just as a percentage of the total. You should come out to the same answer.
Would deferred revenue be just a different account name for unearned revenue?
No, they're actually two separate things. A lot of times in accounting, we have names that are interchangeable,
Yeah.
revenue and income.
Right.
And a lot of people are going to call things differently. Technically, revenue is different than an income. I'm not really splitting hairs with that in this class. generally deferred revenue is different than unearned revenue. Deferred revenue is earned, but for the purposes of the way you're recording it, you can't show it yet. It's a different system. Unearned revenue, it means you have something yet to deliver.
But versus deferred being you've delivered something, haven't picked the revenue up.
Generally, deferred revenue relates to things like separate warranty contracts sold, where you can only record warranty revenue based upon the expenses incurred.
So like gift cards, for example, would that be like deferred revenue?
No, gift cards is a whole different topic. And I mean, there's two things kind of like gift cards. So gift cards is a little different. Then we have something called premiums. And then we have things like frequent flyer miles and how you record things like that. So if we wanted to call gift cards, what happens with gift cards? Do you make a sale? Well, you sold the gift card. You got cash, but you have a liability. So when do you record revenue? Generally, you're going to record revenue as the gift cards are used. So you record a liability, and as the gift card is used,
you produce the liability.
Record revenue. Yeah. It's not really the same concept as the deliverable, but the deliverable, you're more of in control.
Right.
Either it's going to happen on a time basis, or when you deliver what you need to.
I'm sorry. So, for example, like the gift cards, we could be sitting with the gift cards for 15 years before someone hypothetically walks in, uses one.
Right. Hypothetically.
Right.
So a lot of them, some of them have expirations.
Right.
Some of them have charges that if you don't use it each month, it reduces the amount.
Right.
Kind of encourage this, though most people would be happy if you never used it.
Right.
Gift cards, by the way, are a great gift. You can walk into any store and they give them to you free. They're right on the counter. Just pop them in an envelope, give it to whoever you want. They're thrilled. Isn't that how they work?
Of course.
Yeah.
Right? Perfect role.
Kind of the opposite of unearned revenue is prepaid expense.
Excuse me, I have a question about the unearned revenue. Will they pay the whole year, the $12,000 before the issuance for the first magazine? Why is it still recorded as an unearned revenue? I didn't get it, actually.
Because we haven't done what we've needed to do. In order for us to record revenue, we have to provide the good of service, and we have to be reasonably assured of being paid. We got all the money up front, so we've satisfied the reasonably assured, but we haven't delivered the good or service we're required to deliver.
Okay, so that's why it's possible to return the money to the customers. That's why we record it as a... Okay.
Right. And this, aside from returning the money, there's a more practical reason. Let's say it's December 31st or December 15th, and we collect the $12,000. If we show that as revenue this year, we haven't had any expense for that magazine. So we have all the revenue, none of the expense. Next year, we have all the expense of delivering 12 magazines and none of the revenue. So you haven't satisfied the matching principle of matching expenses to the revenues. So we have to do our part, deliver what it is we said we would deliver in order to record revenue. A prepaid expense is where we paid for an expense, but through the passage of time, let's say, we have periods left. A good example is we prepay a 3-year insurance policy. Now, you remember, when we did the salary accrual, we had to know to do that because nothing's happened that made us do it. When we did the interest accrual, we had to know to look for loans on the trial balance to know we may have interest to accrue. With prepaid expense and unearned revenue, a cash transaction occurs. Unearned revenue, a cash transaction occurs, we get cash. That gives rise to the unearned revenue. So that's on the books. When we look at the trial balance, we'll see unearned revenue. And that'll tell us, we have to ask ourselves, is any of it earned at year end? With prepaid expense, the payment of an expense will give rise to recording a prepaid expense. Whenever we see prepaid expense, we have to ask ourselves, is any of it been used up? So if we prepay a 3-year insurance policy on 7/1/15 at a total cost of $36,000, what's an entry we can make? There's a couple of possible entries.
Unearned revenue.
I mean, what is the best way to go about approach? Like, would you do it in multiple journal entries? Would you first record paying the
Cash out.
Yeah, the cash out?
Well, the one we could all agree on is we need to credit cash for $36,000.
Right, debit prepaid insurance.
Okay. Debit prepaid insurance. 36. It wouldn't be unearned revenue because this isn't revenue to us. This is an expense to us.
So is it we're paying out or the money is coming?
We prepay a 3-year insurance. We're always the company.
Okay.
Yeah.
I thought it was a client that prepaid. Okay.
So we credit cash, debit prepaid insurance. So what's the entry on 12/31/15?
Debit insurance expense.
Debit
Prepaid insurance.
insurance expense, credit prepaid insurance. For how much?
Divided by 3.
Okay, and what do you get? You're an ideas man.
Is it six grand?
6,000. 6,000. It's 12,000 a year, and for this year we take half a year since it's 7/1. So we have some choices with this. So let's say it's 7/1. We make this payment, and we don't care about monthly financial statements, but we don't really feel like having to make an adjustment at year end. If we could do on 7/1/15, we could credit cash 36, debit insurance expense 6, debit prepaid insurance 30. So we've taken care of this year's expense at the point we made the payment. That wouldn't work if we cared about monthly financial statements. But if all we care about is the 12/31s being right, that would work. Well, I would say generally, though, this would be the way most people would do it. But this would work too. And if we cared, what would we do if we cared about monthly financial statements?
Insurance expense. 1,000. Prepaid insurance.
Prepaid, how much?
35.
So we could do that on 7/1 if we wanted. We cared about monthly. The other thing computer software will do for us, and it's perfect for an entry like this, it's called the recurring journal entry. If we care about monthly financial statements, what entry are we going to make every month? Debit insurance expense, credit prepaid insurance for 1,000. We're going to do that every month. So the first month we make this entry and we set up a recurring entry. We tell the computer, make this entry every month on the last day of the month. debit insurance expense 1,000, credit prepaid insurance 1,000, and do that entry starting, which month end are we going to start?
August.
August 31st. We've already recorded July. Start August 31st and do that 35 times. And it'll automatically take care of itself. Anything that happens for the same amount every time for a predictable period, you can use a recurring entry. So prepaid expense insurance, one example. Any questions about the prepaid insurance? It's not exactly a prepaid account, but remember we were talking about supplies and how we discussed that most people just expense it, but every textbook wants you to treat it as an asset and show usage. Well, while I'm not fond of it, the technique involved in adjusting supplies is useful to know. One way the information could be presented is you have a beginning balance in the supplies account, you have purchases of supplies, and then you have usage. So what would the ending balance be in the supplies account? 7. Because it's plus purchases minus usage. So the beginning balance, we start the year with 1,000, and we could think in T accounts. Purchases, debit supplies, credit accounts payable. Usage, debit supply expense, credit supplies. Gives us an ending balance of 7. The way most of the information in the problems are presented is by telling us the beginning balance, the purchases, and then at the end of the year, someone goes and figures out how much money is left in the supplies. Now we have to figure out how much to debit supply expense for and how much to credit supplies for.
Debit supplies 7,000.
Well, it's going to be debit supply expense, credit supplies.
Usage was 70,000.
Nope.
Out of 20, which, oh, sorry, 26.
13, right? We're at a couple of chapters. There's going to be ways problems are presented. This is one of those ways that gets used a lot, where if you have a T account, you have a beginning balance and you're given an ending balance. In this case, we've also given an increase to it. We're not given the entry, and then we have to figure out the ending balance. We have to figure out the entry given that we are told what the ending balance is. So if we have 6 plus 26, we have debits of 26 and an ending balance of 13. We know we need a credit of 13. So it's going to be debit supply expense, credit supplies. questions about prepaid expenses or supplies? So what we have in the process transactions, entries, posted T accounts, balance the T accounts, take a trial balance, using the trial balance, we make adjusting entries. We use the trial balance by looking for loans on the books to see if we have to accrue interest. If we have employees, we always ask, are there days unpaid at the end of the year we have to accrue? If we have unearned revenue, we ask if any of it's been earned. If we have prepaid expense or supplies, we want to know, has any of it been used up and have to be recorded as expense? Once we have the adjusting entries, we post the adjusting entries to the T accounts, we balance the T accounts again. We take another trial balance. This one we call an adjusted trial balance. Some people add more columns to the trial balance and they put the adjustments right on the worksheet and then total across to get an adjusted trial balance. And then we prepare the financial statements. And the last process books talk about is the closing process, which I put a circle over with a line through it to signify no one in this day and age does that. When you did it by hand, you had to. But if you have a computer, and there's virtually no one I know still keeping their books by hand, computers take care of this for you. Not that they technically close, but at the end of every period, they could start a new period, and they keep it open should you want to combine periods. So since everybody uses computers, I say the closing entry is unnecessary. I mean, to do it by hand, it's fairly simple. You debit all your revenues, you credit all your expenses, and the difference goes to retained earnings. But if you're not doing it by hand, you don't have to worry about this. The other pieces are part of what an accountant does, so you have to understand how it works. If you're not doing it by hand, you're not posting T accounts. We do make journal entries. That's how the entries get into the computer. We do just adjust balances. Computers won't do that for themselves. But a lot of the mechanics are handled by computers these days. Does anybody have experience working with accounting software? What package?
QuickBooks and CCH.
Oh, so CCH for tax?
Yeah.
And QuickBooks. You know which version of QuickBooks?
It's usually Pro.
Okay. So anybody know of any other accounting software?
Codage.
Okay. There's lots of different versions. For high-end systems, You have very expensive, elaborate accounting that works across thousands of offices and tens of thousands of people. You have standalone systems like QuickBooks. You have specialized systems like
some inventory stuff. Too.
Well, those are modules within.
But then the system.
Yep, as complicated as you want to get. QuickBooks can work for almost any size. I use it, the private foundation, which has almost $800 million in assets.
Why not?
And it's very, very simple, very intuitive. And you could get QuickBooks at a low end. Well, you look. You could get a low end version of QuickBooks that'll do standalone fairly easy for like $50. And you could do it online. It's a little more expensive since you pay monthly, but you could do it online, which is handy. And I'm not trying to sell you QuickBooks. It's just the idea at the very low end, you could still have accounting software. And if you have multiple people in different places, you don't want the cost of a network, you could do it online. They maintain the online for you, and multiple people can sign in and adjust your books. So no matter what you use, almost everybody is using software of some sort. All right, let's do some exercises. 1, 2, 3, 4, 8, and 10. Exercise 1. Consider the following situation. American Airlines collects cash on June 12th from the sale of a ticket to a customer. The flight occurs on August 16th. When should American Airlines record that as revenue?
August 16th.
Okay, why August 16th?
That's when the flight or the services.
That's when they delivered the service that they've been paid for. So what would they call it when they get paid on June 12th? Unearned revenue. A customer purchases sunglasses from Eddie Bauer on January 27th on account. How many people buy on account at Eddie Bauer? That's cool. We walk in the mall and say, hi, I like these, put it on my account and walk out with them. My tab, yeah. I'm going to run a tab on stuff. Eddie Bauer receives payment from the customer on February 2nd. So what date do they record revenue?
127.
The 27th. The payment is not part of the revenue cycle. They've delivered the merchandise, they can record revenue. So it's debit accounts receivable, credit revenue on the 27th, February 2nd, debit cash, credit accounts receivable. March 30th, a customer pre-orders 10 Supreme pizzas without onions. Apparently that's important. From Pizza Hut. So already their judgment is in question. For a birthday party. The pizzas are prepared and delivered on April 2nd. The company receives cash at the time of delivery. So what date do we have entries to make?
April 2nd.
April 2nd. What do we have to record on March 30th?
Accounts receivable.
Only if we've gotten paid. Remember, the entry that gives rise to unearned is debit cash, credit, unearned. What are we owed for? The only thing we have to do on March 30th is make a note that someone wants pizzas on April 2nd. There's no accounting entry required. A customer pays in advance for a 3-month subscription to Sports Illustrated on July 1st. Issues are scheduled for delivery each week from July 1st to September 30th. So what do we record on July 1st?
Debit cash,
Debit cash, credit,
unearned revenue.
unearned revenue. And what do we record on July 31st?
The revenue.
The revenue, debit revenue, credit unearned. How many weeks of subscriptions will this person get? How many people say 12? 3 months times 4. How many weeks are there in a year? How many months are there in a year? What's 12 times 4? So where does these other 4 weeks come from?
5 weeks.
There's a couple of months with 5 weeks. So to be very careful about this, if they get 3 months of subscriptions, it's probably not 12 weeks. Especially not if you start July 31st. Why? July 31st July has 31 days, August has 31 days. September has 30.
14.
So, well, it depends on when it starts and what day they're sent, right? But there's never 3 months of 31 days in a row. So 2 months of 31 and 1 of 30 is the maximum number of days you can get in 3 contiguous months. So it's going to be the most amount of issues. So it's probably going to be at least 1 month of 5 weeks and 2 of 4, if not 2 of 5 and 1 of 4. So it's not going to be 12. It's more likely 13, and in rare occasions, 14, depending on the cycle when they're mailed. So always keep that in mind. Don't always use 4. When we're doing estimates, and I'm doing estimates for expenses, and I do it on a monthly basis or a weekly basis, to get the months right, I have to use 4.3 weeks per month. Otherwise, I'm going to be missing 4 weeks a year of expense if I'm doing it on a weekly basis. I'm thinking something looks great. If I invest in it, I wind up going bankrupt because I'm off by 4 weeks. So always remember, it's sometimes more than 4 weeks per month. Questions about exercise 1? Exercise 2. Now we're not recognizing revenue, we're recognizing expense. American Airlines operates a flight from Dallas to Los Angeles on August 16th. The pilot's salaries associated with the flight are paid on September 2nd. When should they record expense for the pilot? That's when they will, right? Their normal system, but that's not when they should. They're a public company, so we can assume they're doing monthly statements of some sort. If the pilots flew on the 16th of August, then that is the expense of the month of August. So they would have to accrue it. Just like we said, if they're at the end of any month or at the end of any year, if there are days work that haven't been paid, you got to get them in the right period. This is an example of that. They worked in August, they didn't get paid to September, so that needs to be an expense of August. Eddie Bauer pays cash on January 6th to purchase sunglasses from a wholesale distributor. The sunglasses are sold on January 27th. So when they buy the glasses, how are they recorded? They're going to credit accounts payable, they're going to debit. No,
They're buying.
they're buying. I'd buy all day if it generated cash for me. That would be called inventory. So if they're buying sunglasses to resell them, it's debit inventory, credit accounts payable. They're sold on January 27th. So there's 2 entries, let's say. Debit cash or debit accounts receivable if your customers are on account, credit revenue, debit cost of goods sold, credit inventory. So two separate entries, one to record the revenue, one to record the cost of goods sold. So that would be expense when they're sold. Pizza Hut on January 1st pays for a 1-year property insurance policy. Coverage starts immediately. If you don't care about monthly statements, only annual statements, what could you do? You pay for the 1-year policy on January 1st. What entry would the lazy accountant make? Insurance expense, and cash. Others would debit prepaid insurance, credit cash. At the end of the year, insurance expense, credit prepaid. But if you don't care about monthly statements, you can record the whole thing on January 1st as expense. Not have to worry about it. Sports Illustrated signs an agreement with CBS on January 12th to provide television advertisements during the Super Bowl. Payment is due within 3 weeks after February 4th. The day of the Super Bowl, February 4th is the day of the Super Bowl. Sports Illustrated makes the payment on February 23rd. When does Sports Illustrated record advertising expense?
Working backwards, it signs the cash out on the 23rd. It credits cash.
On the 23rd, February 23rd, they'll credit cash.
And debit the expense.
Maybe.
In a lazy contact, I guess.
When do they have an expense? When has the expense occurred? On what date?
Well, they pay it on the 23rd.
Right?
They sign for it on the 12th, but it's actually incurred on Super Bowl Sunday.
The expense occurs on February 4th. February 4th, they've received what it is they've contracted. Now, the problem with January 12th is some people may say, let's record prepaid expense and record a payable because we have a liability. Maybe that's what they could do. You could also argue we don't owe them anything because we didn't pay anything, and unless they run it, we don't have an expense. So maybe we don't have anything on January 12th except an agreement. Most prepaid expenses arise because we outlaid cash. We have to record the credit to cash. So we need to debit something, so we record prepaid. In this case, most of the time, at least for an entry-level accounting class, if cash hasn't changed hands, it doesn't give rise to unearned revenue or prepaid expense. It's usually the exchange of cash that gives rise. So you could argue we've signed the contract, we have a liability, therefore we should debit prepaid advertising, credit accounts payable. On February 4th, debit advertising expense, credit prepaid, and on February 23rd, debit accounts payable, credit cash. I'd say for the purposes of this class, any of those possibilities would be fine. Number 3. Number 3, we go back to number 1, and we use the cash basis of accounting. Is the cash basis a legitimate basis? Can you prepare financial statements on the cash basis? Yes. You can. They just won't be generally accepted accounting principles with an audit opinion that says that. But you can prepare internal statements and give them out and say these are unaudited and they're prepared under the cash basis. You just have to tell people the basis. So using the cash basis, going back to Exhibit 3.1, when does American Airlines record revenue? On what date? June 12th, the date the cash is received. How about Eddie Bauer and the sunglasses? Date the payment is made, February 2nd. How about Pizza Hut?
April 2nd?
April 2nd, that's correct. Sports Illustrated.
February 4th.
No, we're exercise 1.
July 1st.
July 1st. And for exercise 4, we're going to go back to exercise 2 and talk about using the cash basis. When is the expense recorded? American Airlines and the pilot, when is that salary expense?
August 16th.
No, it's paid September 2nd. So using the cash basis, it would be the date of payment. Eddie Bauer purchases sunglasses on January 6th. They pay cash for them, and they're sold on January 27th. So in a true cash basis system, they'd be cost of goods sold on the 6th. In a modified cash basis system, it would be inventory. Pizza Hut pays 1-year property insurance January 1st. January 1st. Sports Illustrated signs an agreement on January 12th. Super Bowl airs the commercials on the 4th. Payment is made the 23rd. 23rd. That's right. We had number 8. We didn't talk about depreciation, did we? And we should spend a moment on it since exercise 8 talks about depreciation. The concept we're going to talk about now is simple. The actual calculation of depreciation will be the subject of a whole chapter later on. The purpose of depreciation is we buy some assets that benefit multiple periods. The two broad headings we use for this class of assets are fixed assets or plant, property, and equipment. You could use those terms interchangeably. The type of items that are included within these categories are land, building, equipment, furniture, fixtures, machinery, vehicles, leasehold improvements, land improvements, computers, and this is more. I'm just running out of space. Not every company has all of these things. Some companies have breakdowns that are important to them. One of my clients, one of their big categories was servers. They had a separate category set up for servers, because for them, that was a big part of their business. A lot of companies combine furniture and fixtures. They call it furniture and fixtures. Some companies, you might say, what's the difference between a machinery and equipment? So let's say you're a manufacturing concern and you have these very expensive lathe machines. They call that machinery. And the photocopiers and fax machines in the office, they call equipment. It's a way of separating them. So not everybody has all of this. But the basic concept is these things cost a lot and they last for multiple periods. They have to be used within the business. So if you buy a piece of land or a building for investment purposes, that's not a part of this category. These are for assets that are used in the operation of the business to produce revenue. Cost a lot, and they last more than 1 year. Now, cost a lot means different things to different companies. That's a threshold. Some companies have low thresholds, 1,000. Other companies have 10,000, some have 50,000. Depends on the nature.
When you say cost a lot, meaning what the company views as an expense.
Right. So let's say we're a carpenter. We had a hammer. That's probably one of the most important tools we're going to use. Definitely used in the operation of the business to produce revenue, most likely last more than a year.
Right.
Do we want to take a $30 hammer and allocate that cost to the, no. So it has to be a certain minimum dollar value. Yeah. And companies could set their own threshold. If they don't capitalize it, which is put it on the balance sheet, it means it becomes an expense. So if I'm a carpenter, I buy a hammer, I spend $30, I debit tool expense. If I buy a $50,000 drill press, that I set up as plant, property, and equipment, probably under machinery. Then I allocate the cost to the period of benefit. That's what depreciation is. It takes these assets, which are producing revenue, and it takes a portion of the cost and puts it in the years in which it's producing revenue so that we can match the expense to the revenue. A lot of companies want a lot of stuff to be capitalized because it means it's not an expense, and therefore, if they, instead of taking something and turning it to expense this year, it'll reduce net income by that amount. If they spread it over 10 years, they only reduce net income by 1/10 that amount. Anybody remember a company called MCI? It was one of the telecom companies with Sprint when AT&T gave up their long-distance monopoly.
Jordan advertised for them?
Did he?
So.
I didn't remember him advertising.
A lot of celebrities.
The CEO of MCI, which was a high-flying stock, is still serving, I think it was a life sentence. He's still in jail. And what did he do? They took a little bit of expense and said, you know what? These expenses really should have been capitalized. These benefit multiple periods, they're not expenses. Now, little probably is not the word, because I think it was $6 billion in 1 year. Now, even today, I mean, we get jaded by numbers, and this is going back like 20 years. But even today, if I told you a company took $6 billion of expense and capitalized it, meaning their net income went up by $6 billion, that's meaningful to most people. If I tell Warren Buffett, you just passed a quarter on the street, I don't really expect him to bend down and pick it up. But I think he stopped at $6 billion. I think most people would. I think most people consider that significant. And to take it out of expense and put it in fixed assets is absolutely mind-blowing. To allow auditors to pass on that and to say that was okay, I just can't fathom it. But it has a big effect. So what we call fixed assets or plant, property, and equipment has a big effect on net income. And generally, people are pretty honest about how they do this. So what we're doing now is saying, forgetting about how we get the number, let's just say the number we want to record. Let's say we have one asset, equipment. Equipment cost $100,000, and this year we want to take a portion of that and call it expense. That we call depreciation. And the entry is to record depreciation expense and credit accumulated depreciation hyphen equipment. Except for land, every one of these accounts will have its own accumulated depreciation account. So if we have all of these, we'll have building. We'll also have building accumulated depreciation hyphen building. We'll have equipment. We'll also have accumulated depreciation hyphen equipment. Everyone has their own accumulated depreciation account. The debits, the depreciation account, goes to one depreciation account. We don't have individual depreciation expenses. It's one depreciation expense, but individual accumulated depreciation. So let's say this year we're recording $10,000 in depreciation expense. That's the adjusting entry at year end to record depreciation. on the financial statements, we'll have equipment, $10,000 less accumulated depreciation. Oops, sorry, 100,000, 10,000. So net equipment of 90. The other way we could do it is called a parenthetical. Equipment net of 10,000 accumulated depreciation, and just show the 90. Both of these are acceptable presentations. So how we get to 10 is a whole different chapter. The process of recording depreciation is an adjusting entry. So for 8, equipment costing $42,000 is purchased at the beginning of the year for cash. Depreciation on the equipment is $7,000 per year. So the adjusting entry for this equipment is debit depreciation expense 7, credit accumulated depreciation 7. On June 30, the company lends its chief financial officer, I'm going to write this one down. June 30. The company lends its CFO $50,000. Principal and interest are due in 1 year. What entry do we make at 12/31? What are the 2 accounts we're going to use?
Interest payable. Payable.
Oh, I understand why it's wrong for the first one and no for the second.
Second,
Who are we in this example?
we're the company.
And what have we done?
We have one.
So do we pay interest on loans we make or on loans we take, right? So this one reverses it. We're not the borrower,
We're the seller.
we're the lender. So the original entry is debit loan receivable 50,000, credit cash 50,000. So year end, the entry is interest receivable and interest revenue. We're the other side of the transaction. We're not the borrower, we're the bank in this case.
Backwards.
Yeah. Now the question is how much? 1750. 7% of 50,000 is 3,500, and we're going to take half of it. On October 1st, the company receives $16,000 from a customer for a 1-year property insurance policy. Deferred revenue is credited. Right, so I would say that'd be wrong. I would have credited unearned revenue. But be that as it may. So the entry at 12/31 is going to be debit deferred revenue, credit revenue. For how much? Okay, how'd you get 4,000?
Well, it's a quarter of the year, October, November, December.
Right,
And since it's for 1 year,
right. So 1/4 of the full year is earned. Any questions about 8? Then we had 10. November 28th, company receives a $4,500 payment from a customer for services to be rendered evenly over the next 3 months. Deferred revenue is credited. What's the adjusting entry at 12/31? So you can see they're hoping to get 3 years out of this text. Because they're using 2018 in the hopes that in the 3rd year it looks like it's still timely. So they debited the cash, 4,500, credited deferred revenue on 11/28. What's the entry on 12/31?
under 1,500. 1/3 of 45.
Right?
From 1,500.
Okay, but debit what, credit what?
Oh, you debit the unearned revenue 15 and credit revenue 15.
Right. They called it deferred,
Deferred, yeah.
but exactly right. Debit deferred 1,500, credit revenue 1,500.
So for the same example from question 8, for the account, could it have been unearned revenue instead of deferred revenue as well?
Well, for the purposes of answering the question, we need to use the accounts they use.
Yeah.
Yeah, my preference is unearned, but if they're calling it
Then
deferred,
you obviously defer based on the question.
yeah, we use their terminology. Yeah. If you're doing it and you have the ability to call it what you want, I'd say the preference is unearned. December 1st, 2018, the company pays a local radio station $2,700 for 30 radio ads that are to be aired 10 per month throughout December, January, and February. They debited prepaid advertising, credited cash. What's the entry on 12/31?
Is it advertising expense 900, credit prepaid advertising?
It is 1/3 of the 2,700. Employee salaries for the month of December totaling $8,000 will be paid on January 7th of the next year. It's nice that you could skip the whole calendar thing in this case. Debit salary expense, credit salaries payable at 12/31 for $8,000. Any questions about that one? August 31st, company borrows $70,000 from a bank. Notice sign with principal and 9% interest to be paid August 31st of the next year. So we're going to have interest expense and interest payable. But for how much?
1050.
I don't know. How many months of interest do we have to record? September, October, November, December, right? 4 months. And it's 70,000 times 9% times 4/12. 4/12 is 1/3. 1/3 times 9% is 3%. 3% times 70,000. 2,100.
Pretty good.
You got it?
Yes, 100.
Thank you. Any questions about 10? Okay. So that takes care of chapter 3. Chapter 4, cash. How many people reconcile their bank accounts? Nobody. 20 years ago, everybody would raise their hand. Why don't people reconcile their bank
Now.
You look online and you say, yeah, there's my one deposit for the month and the 2 checks I wrote. But if you're writing 50,000 checks a month and you're making 1,000 deposits a month, can you eyeball it even on a daily basis? No, businesses can't. Anybody ever have the bank make a mistake in their account?
Yes.
Yeah. It happens all the time. I'm not going to say any one of us it happens regularly, but I'd be surprised if you went through your life without it happening once. How many of these mistakes were in your favor? Almost never. It's amazing that for all these mistakes, you would think it would be an even number of things good for me and things bad for me. But it's always bad for you, of course. So reconciling is important. You also need to do it to know when there's criminal activity in your account. I know banks are very sophisticated these days. And we got a call. Bank said, someone just came into an upstate branch and cashed 2 checks against your account. Could you please tell us if these are legitimate checks? He gave us the number. We said, no, we know those aren't our check numbers. They sent me a copy of the 2 checks. And everybody know you can walk into Staples and walk out with a program to print your own checks? You don't have to buy checks from companies like Deluxe or Intuit or QuickBooks. You can print your own. I used to print my own checks. I printed them on my own account, so that's okay. If I'm printing them on your account, it might be a problem. But they're blank check stock, and it's a software program. And what they did was someone got a copy of one of our checks, so they tried to copy the fonts and all the information. And they lifted the 2 live signatures, one of them was mine, and they put them on the check. So when they sent this to me, I knew our checks well enough to know that this font was not exact. Anybody who handles 1 or 2 of our checks a month will believe that's a real check. And the signature was a real signature, it just wasn't signed by me. It was like a photocopy of my signature, which is a real signature for all practical purposes. So we caught the person. I didn't catch the person. I went to the police station. I told them, I spent like 2 hours telling them how I know how this was done, which checks had to be used, and the whole thing. And they wound up catching the person in relatively short order. We got our money back. It wasn't a problem. The bank put the money back in the account before the day was over. But in order for this to work, the criminal who took our live check and copied it couldn't use the next number in order, because if that had already cleared the bank, it would have kicked out immediately. So what they had to do was skip enough numbers to know that it's probably not a check that is going to come through the bank. But in giving themselves that margin, that gave the banks risk management program that says this is too far out of sequence from the last check. Call the client and see if this is legit. And they quoted, they already gave the guy the money, but they were able to get him back. And so these things happen all the time. How many people have gone into the bank to make a deposit? You have a deposit slip?
No.
You don't use a deposit slip at your bank?
Yes, the bank doesn't require them anymore.
Right. Do they have a machine they put the deposit through?
Yes, they have the new little round one.
Little round thing, right.
They route it, yeah.
That reads the information from the check In the old days, we didn't have those machines.
Didn't everything get sent to New Jersey?
Yes. You came in with a deposit slip and the checks you're depositing, and they put them in a pile and put them in a big bank to New Jersey, and that's where the recording took place. So you walked into a bank, you went over, you took a deposit slip, you filled in your account number, your information, and the amount. When it got to Jersey, they put a micro-encoding, computer-readable magnetic typeface on that deposit slip, and then ran it through so the Fed could credit your account. Someone said, hey, here's an idea. I'm going to take these blank deposit slips and put my micro account number on them. And then I'll just put them into the bank. So everybody who walked in and took out a blank slip, put on the date, put in their name, wrote in their account number, when it went to New Jersey, they didn't put the micro encoding on it because it's already there. They didn't stop to look to see if that micro encoding is the same thing as the handwritten account number. So all those deposits were going into this one person's account who put his number on all those. And when did these people find out? There's no online at this time. You wait till you got your bank statement or a call from the bank saying you're bouncing checks. You know, it's criminal, but it's also ingenious. ATMs. One guy bought an ATM. Anybody could buy an ATM machine. Brought it, put it in a mall, plugged it in. You walked up to the ATM, you put your card in, put your PIN in, you want $100, what do you think happened? You got $100. How many people suspect the problem when they get money from an ATM? Not many. You think, oh, well, it works. At the end of the day, the ATM gave out a lot of money, but it collected a lot of information and a lot of PINs. So you made up all these debit and ATM cards and you rated everybody's account. Took out the maximum amount daily. So it raises a question. Let's say you're in an area, let's just call it sketchy. And you have this half-broken ATM in the middle of nowhere, not affiliated with a bank, but you desperately need cash. What do? You have to use that ATM, you have to get cash. What are you going to do?
Suck it up.
You put your card in.
Suck it up.
You put your card in.
Put your card in.
Put your PIN in.
Put your PIN in.
See if it gives you cash.
See if it gives you cash.
Try it again.
Okay.
See if it gives you cash again.
Right?
If you get cash again, call your bank.
Yep.
Your card, pay your cash, and move on.
Call your bank, tell them what? Cancel my card?
Yeah.
And hope you don't need cash before the night is out.
Exactly.
Anybody else have any ideas for this? If I had, now I've been in foreign countries where I'm not sure, are these legitimate ATMs? So I only use bank ATMs where I can, or airport ATMs if it's a good airport. But if I'm stuck in this situation as I described it, I put in a wrong PIN number. If it gives me cash, what does it mean? It means it's not hooked up to the network. It's not a legitimate ATM. So what do you do if that's the case? I stand there all day. I stand there all day with the wrong PIN. I don't run. I stay there until it stops giving me money.
And then you run.
Well, but if I put in the wrong PIN and I'm getting money, I will do that all day. Yeah. So cash is fairly important. It's very hard to safeguard. If I were to ask you how much cash do you have, what kind of answers would I get? No, so if you wanted to know, how would you figure it out?
Count the money in my wallet.
Count the money in your wallet. That's as individuals the answer we think about. But as companies, the amount of bills and coins seldom represents any kind of amount of cash the company has. For organizations, when we say cash, we mean amounts on deposit. Balances in checking, savings, and accounts in financial institutions. Very seldom is it held largely in cash, in coins or bills. Now, we all keep some petty cash on hand. You know, the Domino's guy shows up because you're working late. He doesn't want to hear, send me an invoice and we'll pay it in 2 weeks. He wants to get paid on the spot. So you need some cash on hand. Anybody work at a place that has petty cash?
No, but I do work for like restaurants too.
Well, even if it's not petty cash, they have to have bills in the register to make change. Yeah. Every place has different amounts. So where we work, we keep about $2,000 in petty cash. But we're mostly talking about deposits at financial institutions. And if there's one thing we want to learn from this chapter, and it's really just one thing, it's how to do a bank reconciliation. The bank reconciliation is the process of taking the balance that's on the bank statement, that's what the bank says you have, and comparing it to what your general ledger says you have. And then figuring out, does anybody have a mistake? Do we have a mistake or do they have a mistake? Are there things they've recorded that we should record but haven't? There's 3 ways to do a bank reconciliation. Neither one is more right than the other. They're all legit. There's one I prefer. This is called bank to book. You start off with the bank balance, which comes from the bank statement, and you have stuff in here that you add and subtract so that you get the balance that you show on the books. Now, what is the stuff you add and subtract? You subtract outstanding checks. Outstanding checks are checks that you've written. And remember, when we write a check, we debit expense, we credit cash. So we're removing it from our balance. Okay?
Well, wait, thank you.
Is there any next of kin you want us to call?
Just a priest.
Outstanding checks are the checks we've written, we've reduced our cash balance, but the bank hasn't seen them yet. So the bank balance hasn't subtracted them. We have DIT, which stands for Deposits in Transit. These are deposits we've recorded that we've added to our cash balance, but the bank hasn't recorded. Maybe we made them at an ATM on Friday, which is the last day of the month, so the bank will record them next month. A lot of banks charge monthly service charges. They would have reduced it from their balance, but maybe we didn't record it yet. So to get our balances to agree, we're going to have to add it back to their balance. Maybe a deposit we made, someone gave us a check, we deposited it, we recorded by increasing our cash balance. Maybe it came back, it bounced. So we have to add that to the bank balance, because they would have subtracted it, but we didn't know about it until it came through on the bank statement. And there might be some other things, but we'll leave it like this for now. So that was bank to book. The other method is book to bank, where we start off with our balance from the general ledger, and we make some adjustments, and we want to wind up with the balance that the bank statement has as our ending cash balance. So we're going to add outstanding checks. Since we reduced it from our balance, we have to add it back to come up with the bank balance. We're going to subtract deposits in transit. We're going to subtract the service charge. And we're going to subtract the deposits that bounced. The third method is taking the book balance, making some pluses and minuses, and coming out with adjusted cash. Taking the bank balance, doing some adjustments, coming out with adjusted cash. And when those two adjusted cashes are equal, then we've reconciled the account. Now, what are those things in there? Well, for the book balance, we're going to subtract the service charge and the NSF deposits. For the bank balance, we're going to subtract the outstanding checks and add the deposits in transit. Either of these three methods are fine. So this is method 3, method 2, method 1. Sometimes, with the stuff that we've done inside, we need to make journal entries. The reason I like this method is because we don't have to think about what entries we need to make. Anything on this side is a journal entry. Anything on this side is not. The method tells us where our journal entries are going to be. Any of these other methods, we have to go through the adjustments to figure out which entries we need to make. The entries will be the same, but it's easier, I've always found, with this method to identify them. So once we've reconciled, we're going to have to debit service charges, credit cash, debit accounts receivable and credit cash, debit bank charges or service charges for the service charge. And since a customer gave us a check that bounced, originally we would have debited cash, credited receivable. Now that that check bounced, they still owe us the money. So we need to put their receivable back and reduce our cash. So given the adjustments in this example, these are what we need to make based upon the reconciliation. And if you could do that from this chapter, then I'll consider it a success. Now, how do we go about deciding which of the outstanding checks? Well, if you have a computer system, there's a bank reconciliation function. When you click it, you get all the checks that you've written. When you take the bank statement, hopefully the bank statement gives you the checks in numerical order. And so if you have a lot of checks, the bank statement will identify the gaps in sequence. So from 10,160 to 10,190, there's no gap in sequence. So you could just check all of them quickly. Then it says
all being cleared that month.
Correct. You're matching the checks you've written against what's on the bank statement. And for every one that appears on the bank statement, you check it in the computer software. That tells the system that they've come through the bank. When you're done, whatever hasn't come through the bank shows up as outstanding checks. And then the process is the same for deposits. you click all the deposits that the bank statement shows. Whatever is left is deposits in transit. In addition, while you're doing this, you're looking for things on the bank statement that aren't in your account. Service charges, interest, bounce checks. And those are adjustments you need to make. So any questions about bank reconciliation? It's one of those things that's hard to comprehend until you do it a couple of times. Now, my mother used to do bank reconciliations. I may have been a little kid, but I knew this was a problem. It upset me greatly. She used to write a check for $9.50, and in her checkbook, she'd record it as $10. She always rounded up the check. Why? Because it was like found money. And I'm thinking to myself, you could never reconcile to the penny. And it was probably not important to her to reconcile to the penny. Me, I couldn't live without that. I don't know if you remember your first double date. I remember my first double date. Because I itemized what each of the couples had and allocated the tax based on the proportion of the total.
Oh.
That was my last double date for a long time.
Another double date out of that?
Surprisingly not. But it seemed like the right way to do it. But it took me, I don't know, maybe 30 years to get the concept of splitting the check. You know, it's really the right thing to do, but for years, I didn't have alcohol. Why am I paying for half your drinks?
Easier.
It really
The
is.
other person can pay tip or,
Yeah, there's ways to offset, to even it up. Yeah, but it just upset me as an accountant. Pay for things I didn't have. Well, bank reconciliation, you want to get to the penny. My assistant, she hates it when I make it. I'm only $60 off. I don't care. You got to be to the penny. Find it. Next day, I can't find it. Something's wrong. I said, let me look at it. Oh, here it is. Oh, damn you.
Yeah, when you have a fresh set of eyes comes in.
Now she'll spend a week before she's so afraid I'll find it if she doesn't. 5, 6, 7, 9, and 10. Let's take a look. Chapter 4. All right, exercise 5. Here's a list of things. Calculate the amount of cash to report in the balance sheet. So we'll just go down each one and say whether it's cash or not. Currency located at the company, is that cash? Yes. Supplies? Short-term investments that mature within 3 months. Generally, no. If it's U.S. Treasury bills, that could be considered a cash equivalent. Some companies say cash and cash equivalents because it's so near maturity that changes in interest rates won't affect the value. And there's no thought that is a possibility of it defaulting. Accounts receivable? Not cash. Balance and savings account? Yeah, that's cash.
But it's not cash, it's in the account.
That's okay. We consider cash deposits at financial institutions.
I thought you consider cash, like petty cash, like the cash that's available versus.
No, most cash is cash in financial institutions, not petty cash.
Okay. I was just trying to differentiate even further, so I was getting
No,
actual cash. It's in my
no, don't get so fine with it.
Okay.
This is, when we talk cash, we mostly mean checking accounts and savings accounts. Checks received from customers but not yet deposited. No, has to be deposited to be cash.
So cash in your hand is cash, but paper that says it's cash isn't cash. Good, right?
Can you take that? If you walk into a store and write a check from your account,
Yeah.
they're going to take the check?
Yeah.
If you walk in with a customer check and say, I'm going to use this. No, you need to deposit
Can't do it, but
that
you're supposed to be
first.
able to do it. You're supposed to co-sign the check, over your name.
It's
a note.
well, yes, commercial paper,
Yeah.
but still not cash
You're
until
right.
you deposit it. So you need to deposit it. Prepaid rent, not cash. Coins, cash. Equipment, not cash. Balance and checking account, cash. Does everybody know how petty cash works? Petty cash is called an impressed account. Most companies have a box, petty cash box. Our company, we have $2,000. In the box is cash, coins, and receipts. So let's say we start out with $2,000, that's the balance. We paid $20 for pizza. So now there's $980 in the box and a $20 pizza receipt. Let's say we take $100 to buy postage. So now there's $1,880 in cash. A $100 postage receipt and a $20 pizza receipt. At all times, the combination of cash and receipts totals $2,000. That's the impressed nature. It's always totaling to a set amount. Now let's say the amount of receipts has grown and the amount of cash has dwindled. And we want to replace the cash that's missing. So here we have $120. We're going to take those receipts out and we're going to write a check. We're going to write a check that someone's going to take to the bank for $120 in cash and bring the cash back and put it in the box. So we took the receipts out and added $120 cash. So now the box has $2,000 again. What's the entry to record the $120 going back in the box?
Cash receipts.
Okay, so we're going to have debit meal expense, 20. Debit postage expense, 100. What are we going to credit?
Petty cash.
No.
I mean, it depends how you.
Doesn't depend. The answer is no.
No?
No.
Okay.
All the time?
All the time?
No, yeah.
What if you take petty cash as like an office expense, though?
We have this account called petty cash,
Right.
and there's $2,000 in it.
Right.
If we credit petty cash, what's the balance? 1880. So how much are the people who hold that accountable for, according to this? How much cash is now in the box? No,
Oh.
2,000, right? It's like freedom to take money. You tell them, you're accountable for 1880, and they say, well, there's 2,000 in here. Okay, I'm going to take the 120 out. We wrote the check from the checking account to replenish the petty cash. So we credit cash. It's coming out of our bank account for that check we wrote. The cash is going back in. We never debit or credit petty cash unless we're changing the balance in the box. Because we want the general ledger to always show the accountable amount. So once we establish it, when we establish the box, we debit petty cash 2,000, credit cash 2,000. When we remove receipts, we debit the expense and we credit cash. We don't touch petty cash. Douglas & Son uses the following process for its cash receipts. The company typically receives cash and check sales each day, places them in a single drawer. Each Friday, the cash clerk records the amount of cash received and deposits the money in the bank account. Each quarter, the controller requests information from the bank necessary to prepare a bank reconciliation. Generally a bad process. One, you need more frequent information from the bank than quarterly. You want to do it monthly. And two is having one person receive the money, deposit the money, record the money is usually a bad idea. You usually want to have segregation of duties. One person who has access to the cash isn't the person who records how much there should be. Separating the duties allows one person to say how much should be there without having physical access to it. Otherwise, the person's just going to say, oh, yeah, there's going to be $5. Yeah, that sounds about right. Who knows the difference? Sometimes in small companies, you can't have a lot of segregation of duties. You have one person that does the whole accounting function. So what you need to do is establish management controls, mitigating controls. Someone who opens the mail, if they see a check, they automatically stamp it on the back for deposit only before it goes to the person who's recording it. Someone else records receivables. Because if someone tries to keep the check, you wouldn't have reduced the receivable account. So when that person gets the statement, they're bound to call and say, I paid. Did you get my check? And when they give the check, a copy of the check to prove that they did indeed pay, and you see someone else deposited it to their account, that'll come to light. So segregation of duties. 7, Goldie and Kate operate a small clothing store that has annual revenues of about $100,000. The company established the following procedures related to cash disbursements. Petty cash fund consists of $10,000. My God, that's a lot. 10% of annual sales. That seems like a lot of money. Employees place a receipt in the fund when making expenditures and obtain the necessary cash. So it sounds like an honor box. You have $10,000 and someone drops off receipt. Did anybody ever see the movie Dumb and Dumber?
Yeah.
They got this briefcase of cash.
And then they have the IOUs.
They put in IOUs into this ferry, the Lamborghini they bought. They put in IOU for $150,000. For any expenditure not made with the petty cash fund, the employee writes a check. They're not required to obtain permission to write a check, but are asked to use good judgment. Any check written for more than $5,000 could be signed only by Goldie or Kate. Goldie and Kate should not be in business. Petty cash is way too high, an honor system doesn't make any sense, and allowing employees to write checks is a bad idea, even if there's a limit of $5,000 on it. That's a high percentage of their annual sales. Now, a lot of companies give employees the right to make expenditures. In my company, you don't need a receipt for reimbursement if it's less than $50. A lot of people do a lot of cabs, and a lot of times collecting receipts. We say, $50, we'll take your word for it. Petty cash, you can get petty cash. They can't access the petty cash. They can't go into petty cash, but they could say, I need up to $25 from petty cash and provide a receipt. Or, 25 would be less than the receipt limit, but generally they would have a receipt. But they wouldn't have to. But they could say, I need cab fare $30. We'd say, no, it's above 25. You need to request a reimbursement. Or they say, we need $20 for cab fare. We'd say, oh, yeah, here's $20. Just sign, you're taking cab fare. No employee can write a check except for the authorized signatories. And all our checks require dual signatures. And you can't sign your own check. So when I get paid, I have to get someone else to sign my check. I'm usually one of the signatories. But if it checks to myself, 2 other people must sign. So this is just bad top to bottom. 8, Janice Dodds opens the mail for Ajax Plumbing. She lists all customer checks on a spreadsheet that includes the name of the customer and the check amount. The checks, along with the spreadsheet, are then sent to Jim Seymour in the accounting department. Do they really think giving both names adds some things to this? They just said Jim. Would that be different than knowing his name is Jim Seymour? I can never figure out why they do that. Well, I know when I wrote my books, I used my kids' names and their birthdays, and they love to see their names in it. So maybe these are relatives of the authors. Okay, so she lists all on a spreadsheet, now customer check amount. They all go to Jim Seymour. What's the problem with that? If she wanted to keep a check, she just wouldn't put it on the list. Someone else should keep track of all the checks before she gets it, and then she could send the list, and Jim can check with that first person what the total should be. Anybody ever go into a store where they have the cameras, not on the customers, but on the employees?
Yeah.
Oh.
Anybody ever go in a store and they see a sign that says, like a fast food place, if you don't get a receipt, your purchase is free?
Yeah.
You know why they do that?
Yeah, so employees can't take cash.
They're making the customer part of the internal control system. When you see that sign, what are you thinking?
Employees probably steal from this place.
No, I'm thinking,
Receipt. Receipt.
I don't want that receipt. I'm hoping they don't offer me that receipt. Because if they don't offer you the receipt, they can pocket the cash. But if you're there wanting them to try not to get it, the first thing you say is, I didn't get a receipt, it's free. And what do they have to do? They have to account for it. Why did they get a receipt? We're trying to steal. I used to own laundromats. The first couple I owned were dumps. I mean, every dumpy laundromat you ever imagined. And so we used to do drop-off service. Customer brought their clothes in, they would drop it off. We would wash it, they would pick it up. And there was a period of time when we didn't have an owner in the store. And so when I went to the store, I saw that they weren't using our system for customer tickets. We would write a ticket for the customer, they get a copy, we have a copy, and we would use that ticket to track their laundry as we did it. So I went in during this period, all of a sudden we're using Post-its instead of these official duplicate tickets. So I knew it was getting stolen. I knew that's what it was. So I didn't say anything. Why? Because until the owner came back that it wasn't going to be in the store, I didn't want to be there. So it's just the cost of business. Later on, I sold those, and I opened a new laundromat, beautiful laundromat, designed unlike any other in the world. Piece of beauty. It's like the Lamborghini of laundromats. It won most beautiful laundromat in America. And we didn't have to use customer machines. Behind the counter, we had our own 3 washers and 3 dryers that were only for drop-off service. So we didn't have to worry about this tickets, and it was a computer. Everybody got a barcoded customer receipt. System kept track of how they liked their clothes when they brought it in, so they didn't have to repeat things. Long story short, part of having tight controls, we didn't use quarters. We had our own custom debit card. But my son owned the soda machine, and my twin daughters owned the snack machine. And everybody's used the snack machine where the thing got stuck. And so what do you usually do? Usually kicks, right? Yeah. I didn't want them messing with my daughter's machine. So the rule was, and everybody knew the rule, if you had something get stuck, go to the front counter, we'll make sure we get that out plus the next one and you get both of them. So we would always do that. So I hired this one person Friday nights. And I didn't want to work Friday nights. So this person, first day, I had to give out $5 because stuff got stuck. I had to put the money in the candy machine. $5. I've never had $5 in one day before. Next time it's $10, right? So I'm thinking, all right, it's really shift premium. It's theft, but I'm calling it a shift premium, a little extra to make up for them working Friday nights. Then one time she insulted my intelligence, and I couldn't take it. I could take the loss of money. It wasn't the money, it was the explanation.
Oh, God.
We have these debit cards. And the rule was, when you got the card out of the machine, you had to give a deposit. And if you give the card back to us, we'll give you your deposit back. It was a $2 deposit. And we wanted them to return the card because they cost me $6 a piece. Someone took it like a Metro card and threw it away when they were finished, cost me $6. So the deposit meant they probably were going to give it back. But sometimes there's a balance on the card. And they wanted to get the balance back. And the rule was we don't refund balances because we also give bonuses at times. So we don't want someone to come in, get a bonus, do their laundry and say, I want $20 back, when they didn't pay anything for the laundry because they used the bonus to do their laundry. But the unwritten rule was we don't want unhappy customers, so if they give us the card, we'll give them the balance back. We'll give them the token, I'm sorry, we don't refund balances. If they say one word after that, yes, we'll do it for you, this one time. So this one says, and I had to refund $20 on the card. I said, all right, where's the card? She said, well, they said they wanted to keep doing laundry, so I let them keep it. So she gave money on the card without keeping the card, which was really, so I said, all right, forget it, this is not going to work. So you always have to be thinking about how people are going to find ways to exploit the vulnerabilities in your system, no matter what it is. And if it starts low and they get away with it, they'll keep going until you get to a point where, you know what, I'll start working Fridays if I have to. And cash is the worst. Cash and candy machine. Did we also have 9? 9 and 10. Spielberg Company's general ledger shows a checking account balance of $222,970 on July 31st. July cash receipts, $1,885, included in the general ledger balance, are placed in the night depository at the bank on July 31st, processed on August 1st. Bank statement dated July 31st shows bank service fees of $55. Bank processes all checks written by the company by July 31st and lists them on the bank statement, except for one check totaling $1,460. All right, got to do a bank reconciliation. So what's the book balance?
22,970.
What's the bank balance?
22,490.
Now we have to start with our adjustments. The bank balance is going to get minus outstanding checks plus deposits in transit. How much were deposits in transit? $1,885. The bank is going to record that as a deposit in August. We record it as a deposit in July. And how about outstanding checks? $1,460. Anything we have to record on the book side?
The service
Bank
charge.
service charges.
So let's say. So at this point, adjusted cash according to the books is $22,915. And how about according to the bank? Booyah! All right. There we go. So we would be done. And we would have one journal entry to make. Debit service charge, credit cash, 55. Any questions about 9? Okay, try 10 yourself. Done already? Oh, you did. So what adjustments do we need on the book side of things? We have a service charge of 35, and we have interest
46.
of 46. So what does that give us?
79.55.
And how about on the bank side of things?
Deposits and funds of 3,338.
Okay.
So 1425.
And then what does that give us?
79.55.
79.55? All right. So now the journal entry we're going to need is debit service charges 35, credit interest revenue 46, debit cash 11. And we can see that the book balance to the adjusted cash is $11 difference. So we have to increase the balance by 11. Any questions about chapters 3 or 4? Okay, next time we have chapter 5. Week after that, no class, college is closed. The week after that, no class, college is closed. The week after that is January 5th, exam 1. But I don't know if it's good news. Don't come to class on January 5th. It's a take-home exam. So I will email you the exam probably a week or two before it's due. It'll be due by 9:30, emailed 9:30 on January 5th. So I'll email you the exam, give you a couple of weeks to a week. Let's call it a week, maybe longer. Just email it back. It'll be Word form. And it'll cover 1, 2, 3, 4, 5. So don't come to class for those 3 weeks. We have class next week. Then we are off for 3 weeks. One of them, the exam takes the place of the class. The other 2, this college is closed. Or I can make arrangements to have someone here to give you the test, your choice.
No.
Okay.
Stick with the first.
Only because you don't want me to go to any trouble. Thank you. All right, I will see you next week. Anybody?